Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is long verticals and diagonals, and the markets are taking a beating. They're falling. So we're going to talk about trading bearishly in a bearish market. I know that's a pretty sophisticated topic, but it's an important one. So I'm going to be placing a long put vertical spread today. We're going to be talking about the pros and cons of that strategy. We'll take a peek at the markets and also look at existing positions. Before then, a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody who's already out there in YouTube land. Hello to my live audience. Life in the Fast Lane, Selva, Greg, Naresh, John, Ray, Scott, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. But be aware that you're invited to join us in the live discussion. This is a Thursday webcast series. It kicks off promptly 11 Eastern time. We'd love to have you here in the live audience if you'd like to join us. And also as a treat for our live audience members, we have Connie Hill joining us here in the chats. Connie's going to be assisting me with any questions that I can't get to just during the flow of the presentation. Thanks for being there and having my back, Connie. And Connie and I would like to issue an invitation to everybody. If you have an account with X, give us a follow there. That's the best place to connect with your favorite presenters in between the live streams. So you can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. All right, but let's get into this discussion. Of course, before we go talk about trading the markets, we need to talk about the risks associated with doing that. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for the day. I've already sort of tipped my hand there for what we're going to be covering. But first thing that we're going to do is look at existing positions in our example portfolio. There's a lot going on. Let's see what's happened to that portfolio as a result. Number two, we're going to take a quick peek at the markets. We'll try to make it fast for the bulls in the audience who'd rather cover their eyes. But then we're going to go plan and place a new example trade. Today's trade is going to be a bearish strategy known as a long put vertical spread. So we'll weigh the pros and the cons of it as we plan and place that trade. But let's go right to Thinkorswim and look at our current positions. We have seven positions. And, you know, I looked at this number, and I'll admit I was a little bit surprised this morning. We actually have a small profit across the range of our 7 positions, which sometimes feels like an accomplishment with a market like we have right now. So that's good. Let's see the individual positions, though. We have Apple, first of all. This is a long call diagonal. Currently, we own the 16th of January 2026 235 call. That has 288 days left on it. And then against that, we've sold a 17th of April 240 call. Now, that position right now is underwater as currently constructed by $1,500. Let's go to the charts and see there was a little bit of history to this one before its current construction. The original trade was taken back here on March 6th, where we bought the 235 position that we still own and sold a 250 call against that. That 250 short option has already been closed for a profit. We realized $292, you know, not including commissions. So that helps us a little bit, a small consolation prize against the $1,500 that we're currently down net on the entire remaining position. But after exiting this short position, we sold a 240 short call, and this was doing okay until today. The preference when we have a 235 call is for the stock to go up. But when we're in a short position, we'd like the stock to stay below that price. Well, there wasn't any threat of that necessarily, or not much of a threat, you know, getting above 240. And then we have this morning's open. Now we have a note here on our chart, and we're going to abide by this for better or for worse from here forward. Exit if support breaks. We looked at this, noted that we, on a recent sell-off, had come down to a previous price floor. And we decided at that point, if we fall below that, we're no longer to remain in this bullish trade. So let's wrap it up. Let's go back here to our Apple position. We can just right click on that. Let's create a closing order and sell out of this diagonal, right? So this is going to be a realization of loss. It's going to be probably around a $1,500 loss minus the $292 that we've already made as profit, maybe looking at about a $1,200 setback on this after all has been said and done. So Apple, looks like we might be able to pull about $11.34 out as a credit. Let's say we're willing to settle for less than that in the interest of trying to get a faster fill. We're still going to submit a limit order, so there's not a guarantee that this is going to fill. But let's click confirm and send. We're selling to exit this long diagonal spread, trying to retrieve 1130 from this minus commissions. That would leave us with a minimum acceptable credit of 1128.70. Let's send that off and let's see if that fills. Let's let that work for a little bit. So you can see the working order right here. But Carol, you got your eyes covered, and Ricebird, a lot of you are peeking. You got that little peeking through the fingers emoji. Yeah, let's have a look at last week's trade. This is our Amazon long call vertical spread. Yeah, guess what happens to long call vertical spreads, which are bullish, when the markets take a steep dive. So I saw somebody say, hey, Cameron, can you explain what's going on? Well, I think the big news this morning is not a big surprise to anybody in retrospect, but the unpleasant surprise for some market observers was there was an announcement of even higher tariffs than previously anticipated. I think it's about 54% on China, 25% on cars, 20% on EU imports other than cars. Pretty big tariffs out there. 10% at least on all global trade. So the concerns of what one might consider to be a global trade war, those are now elevated, and the markets are coming down in apparent reaction to that. But in any case, our Amazon trade was bought the 185 call, sold the 190 call. We'd like to be above 190. Today has really kicked this down. There's still 43 days left. We're not going to be making a change to this position right now, but we're not doing well on this straight out of the gate. So there's our current position. We were doing fine until close yesterday. There's that gap down. We'll have to see if this remaining time on these contracts can give us an opportunity to get back up into this profit territory. So let's go back to our positions here. We have GILD, which is a long call diagonal spread. This one actually is quite profitable, $4,000, thanks to the strong move that GILD made to the upside. That is, the current position is quite profitable. We did take some setbacks along the way, so that chips into those gains, but overall, trade's doing well. Bought a long call. We've sold a couple of short calls against that. These two we took a loss on. This one we took a profit, and now we're in a current short call right there at that 115 strike. So the preference here would be for our stock to continue to rise, helping out our $95 long. Oh, it looks like we're out of that diagonal there for 1139. Okay, but we'd like to see the stock rise to help out the long call that we still own, but to stay below that 115 level. Interestingly, this is one of the probably very few stocks that's actually having a decent day again. So that's taken us up relatively close to that short strike. So that trade's doing okay. Now, we also have JP Morgan. That's another long call vertical spread. With this one, 260, 265. We already took some of this position off. We kicked this off with 7 contracts. We cut this back by 4 contracts and left 3 in play. The preference here would be for the stock to climb back up above 265. Hasn't done that. We're down at 228. And as a matter of fact, very little remaining value in these 3 contracts, 15 cents. Let's go look at what's going on with JPM. So this one, bullish trade, we need to be way up here, way up here. Look where we are. Need to get way up there for this to have a chance to reverse. Is there much chance here? Nope. Very little chance at all. There is a wild card right there. So here's a question. Before we just close this out, because there's still $15 in each one of those contracts, that's about $45 left on the table that's most likely just going to evaporate if we don't do something. But when this took its initial dive, we sold off hard, got a decent recovery right up to here. We thought, not looking good. We're coming up against that resistance again. We took off most of the position here with a loss, but not anywhere near the maximum loss. But since then, we've sold off again. So here's a question. 15 cents per spread. That's $15 or $45 that's still on the table, probably going to be lost if we don't do anything. Let's be honest, we need to get way up there. But is there a possibility on this earnings announcement, which happens before expiration, could we get a reversal of fortune here? RG is saying stay. Look what's happened in the past before. It's not impossible. Is it improbable? Yeah, it's improbable. But it's possible we could get the pop up. So there's the question that the trader might be asking themselves. There is a small chance we might be able to salvage something out of this. The much greater probability is that we just lose the $45. What do we think? John says, let it ride. RIG says, stay. Marcus says, you just jumped in. Okay, maybe into a new position. That would be a very different scenario than what we're facing right now. But, all right, I got 3 votes. RG said stay. John says let it ride. Scott says bail. All right, we'll stay with it. We'll see how it goes. That'll make it interesting over that earnings announcement. We'll come back and see if that helps us out. Lowe's is a long put vertical. Well, I got a big surprise for you. It's actually making money. This is a bearish trade. Yep. With this one, we prefer for the stock to be below our strikes. We have the 240 and 230 strikes. So if we want to be below that, we'd need to be below 230. And right now, we're at 223. So that trade is doing fine. NVIDIA, this one has pretty much capped itself out. This is also a long put vertical spread. We entered into this trade for about $3.60. It left $1.40 of potential. That is $12.70 minus $9.10. There's our $3.60 investment. We're hoping that this spread would increase in value to about $5. It's a $5 wide spread. Well, if we look at the difference between the values right now, they're exactly $5. This thing has done us all the favors it can do us. So even though there are 14 days left till expiration, I'm closing this one out. We can look at it on a chart if we want to. So here's our vertical spread up here. You can see how NVIDIA has acted since we entered this position. We're well down into profit territory, and we basically hit our theoretical maximum gain. We're probably going to have to give up a few pennies to get a fill here, but let's see. Let's right-click here. Let's create a closing order to sell out of all of these and take that profit. It's going to say, oh, Cameron, you might be able to get $5.02. No, sometimes the spread between the bid and the ask on the different strikes, especially when something has gone way out of the money or way in the money, we can get a wide spread. They can create the illusion that maybe the trader can do even better than they thought they could. It's just unlikely that we could actually fill, for example, at 505. Instead, I'm going to back off of this and say, you know what? What if let's just say we're happy to get out at 490, 10 cents short of maximum gain. Now, even if we submit a limit order at 490, it doesn't mean that we're going to receive a credit of 490. First of all, it might not fill, but also second of all, it might fill for more than that. But let's see if we can get out of this. Let's click confirm and send. Going to sell these verticals. We don't care about the max profit, max loss. These are as though we were starting or opening a new trade. This is a closing transaction. There is a commission, so that'll chip into those profits a bit. But let's send this order off and see if we can get a fill. 490, it might feel like we're being generous. We'll see. Okay, oh, look at that. We did fill at 490. Okay. And then finally, we have UNH. So UNH is the trade that we took at the start of the year, and we decided we're going to trade this thing all through the year. And we wanted to see how that works. Actually, even though this is a bullish strategy, it's kind of crept its way back to break even. Right now it says, oh, look at this. Uh-oh, we're down $1,900. That's on the trade as it's currently constructed. But along the way, we've collected some profits on other short call positions. Anyway, this is a long call diagonal spread. Back on January 9th, we bought the 520 call. That's been up and down. Look at where it is right now. It's right at break even. Now, along the way, we've sold some calls against that. So let's have a look at this. So here's UNH. We bought that 520 call right here. You can see it went up. We fell back hard. That really hammered this call, but then it's had a very strong recovery. As a matter of fact, it is kind of having a pretty good day today in the face of what the rest of the market seemed to be confronted with. But this 520 call has had a really nice recovery, now back above break even. But we do have a short option here. The preference actually for this trader, if they don't want to be faced with potential assignment on this 530 short call, which expires here on April 18th, there's our expiration. We'd actually prefer a little dip to get down below that strike. With that short call in the money, there's now an elevated risk of early assignment. Now, there's no risk of early assignment of paper money because no fake contracts are ever assigned early. But in real life, that would be a potential real concern. But from here, we need to keep an eye on this and see if we can peel back. If not, we might need to close that out, close that short call out, give that that long call more room to run. But here's the history of this trade. We originally sold a 560 short call. We closed that out for an 860 profit. We sold a 550 short call. We closed that out for a 672 profit. We sold a 540 short call. We closed that out for a 370 profit. If you add all those up, that's a $1,900 profit on completed trades. Now pair that up against the $1,800 unrealized loss on the current position, and actually this trade is making money. So we'll see if it continues to do that. Not going to make any changes. We'll have a look at this again next week, see if it can peel back and come back down below that 530. Just realize we have a luxury that we can do that at paper money because there's no risk of assignment, but there could be assignment in a real account. So that's it for our current positions. Now, all you bulls, get ready because we're going to go have a look at the S&P 500. Here's what's been happening today. The S&P has been trading along an apparent ascending ramp. Sometimes it blasts off from that. It comes back down to that floor, touches, and then it's blasted off again. And we've been keeping an eye on that over the last several weeks because we'd come back down to that apparent price floor, started up off of that level, came back, maybe started to give some signs of what we might call a potential double bottom. Doesn't look like it at this point. We've broken down below that, and now what we might have from a technical vantage point is a broken trend line, a broken support, and now we might even have, let's just draw this in here. There's a high. It's lower than the previous one. There's a high, and there's a high. We had a low, we hadn't accomplished a lower low until today. So for some technicians, they might see that as a sign that things, maybe we're going to go further down. Now, are we going to go further down? We'll see. But let's just take the position of a hypothetical trader out there who just is now, they're bearish on the markets. Maybe they already have some bullish strategies underway in their portfolio, but they want to start to bring in a little bit more balance. Maybe by adding some bearishness to the portfolio. So that's what we're going to be doing today. We're going to be doing a bearish trade. And the stock on which we're going to be doing that bearish trade is Microsoft. So how did I choose Microsoft? Well, number one, we don't already have a position on this stock. It's one of the largest, most liquid stocks in the world, which can be important for an option trader. Liquidity really trickles down from the stock to the options, it gets worse. If we have an illiquid stock, its options tend to be even less liquid, and that can cause issues with pricing and make them hard to trade profitably. And trading is already difficult enough as it is without us making it harder. So here's what's been happening with Microsoft, and we'll see where it goes from here. But Microsoft has been holding above 385 all year long. It teased below 385 for about a week right there, struggled above, and now on a big, strong red candle day, we've fallen down below. Now, that's on a 12-month view. Let's go out to a 3-year view, and you'll notice that this has been support for all of the last, actually, about 14, 15, 16 months. Are we out to maybe 17 or 18 at this point? Before that, it was a price ceiling. So when that sort of a support and resistance area is broken, for some traders, that can be extra bullish if we're getting a break to the upside, or extra bearish if we get a break to the downside. So let's say that our trader thinks that Microsoft is just unlikely to recover and stay above this 385 level, at least for a while. Okay? How much of a while? Well, we need to make a decision here. We could go out here and place a trade for May, but what's in between now and May? There's an earnings announcement. Some traders don't mind trading over earnings. As a matter of fact, it may cause them to get even more aggressive, because if we get a very disappointing earnings, this could cause the stock to make a strong move, and a trader might be able to leverage that in, let's say, a bearish trade, which is what we're planning today. Or for others, they might say, let's just forget the earnings. Let's avoid the earnings and place a trade before that. Maybe another one for April. Looks like our earnings are scheduled for just after that April expiration. And let's just take that out of the equation. Alex said, this is what I want to hear. John says, Cameron's very comforting in an environment which is uniformly extremely volatile. Maybe it's my tone of voice. It's no more pleasant for me to look at the performance of a 401k that's struggling than anyone else. But yeah, these are just sort of the realities of markets sometimes. When you get to a certain age, you've been through it before, right? You know that market ups happen and market downs happen, and what the trader might want to do is just sort of prepare themselves with a good group of strategies that can be employed regardless of the market conditions. Because in the old days, when I was a young man, I thought, oh, well, I guess you just buy stocks and you just hope they always all go up. So let's plan our trade here. Now, someone going over that earnings announcement, I don't know, do we have time for 2 trades? Let's build at least the first trade, and let's be a little bit less aggressive with this one. Let's go for the higher probability scenario here. So we're going to do an in-the-money bearish vertical spread. So let's go to our trade tab. Let's open up our scratch pad so we can outline this thing. And let's keep this one before that earnings announcement. That's still going to be the 17th of April expiration. And with an in-the-money put vertical spread, what we'll look for on Thinkorswim, we look for that sort of yellowish background. The transition in colors between the backgrounds is just a quick cue regarding whether the contracts are in the money or out of the money. And the ones with the darker background are the in the money. And with our, let's see, with our stock resistance up here at 385, let me look at something here. How much could we pull out of this as a possible profit potential if we did like the 385, 390 vertical spread? Okay, so here's going to be our example trade. Let's make this bold. Example trade. We're going to do a long put vertical, or a long put spread, whatever name you want to give it. And let's say that we're going to buy the 17th of April. This is sort of the driver of this strategy. Buy the 17th of April 385 put for between 1450 and 1470, we'll call it 1460. And at the same moment, we're going to sell the 17th of April 390 put. Forgive me, every once in a while I get a little bit ahead of myself. Can you forgive me for doing this backwards? We're going to do 390 as the driver, of course. And that's going to be 1780 to 1805. Let's call it 1795 that it costs us here. And then we're going to sell the 385 put for, yeah, that's changed a little bit. Let's call it, we're going to be a little bit generous, 1450. There we go. All right, so with a little bit of snafu, what are we doing here? Well, when we have the right to, pardon me, when we buy the 390 put, we're spending $17.95, but that's giving us the right to sell shares for $390. At the same time, someone else has the right to sell shares to us for $385. So if both of these contracts, if the 385 is assigned and we buy at $385, and then we exercise and sell at $390, that's a $5 profit, is the way that I'll describe that if this were a free trade. It's not a free trade. This trade costs us some money. What is the cost or the theoretical max loss of this trade? Well, $17.95 minus $14.50 is about $3.45 to set this trade up. Isaiah says, Cam, with the VIX being above 25, shouldn't we be selling for higher premiums? Isaiah, it's a good question. But in this webcast series, I don't get into credit spreads at all because it's called long verticals, right? So for some, could they do selling on that evidence? Possibly. Now, I'm gonna say something else here, though. Whether we do a credit spread or a debit spread, if we do those on the same stock or the same strikes on the same using the same expiration, it doesn't matter. It really, there's very, very little distinction between either one of those approaches, regardless of where the VIX is. That can be a surprise for some, but the profit and loss and probability scenarios of those trades are going to be essentially identical, and across a range of those sorts of trades, 100 trades, 200 trades, even those differences are going to start to evaporate. Now, there can be slight distinctions like what we want to have happen at expiration. One might expire, the other one we're looking for assignment, but yeah, it really does come down to the trader's preference there. But bottom line is, I don't get into credit spreads in this webcast. It's not to be dismissive of that strategy. It's just that's the title of the webcast. So, yep, good question. All right, so 345 to set up a trade that might turn into $5. So that leaves us with, as a theoretical max gain, we have $5 minus that 345 cost leaves us with $1.55. So let's map this out on our, as a matter of fact, let's do this. Let's see if we can get a quick fill here, and then we can map it out on our chart. So 385, 390. Here's a quick way to create that trade. Typically what I would do is I'd come over here and I'd just hold down the control key and start clicking on things. Here's another way to do this. How many of you have done this before? You go up to spread and we go down to deep and wide. Let me know, have you used this deep and wide feature on the Thinkorswim option chain before? So deep and wide, what that does is we describe to the system what sort of strike pair we're using. Both of these contracts are in the same month, so it's just 1 month that we're dealing with, but they're 2 strikes apart, and it's a vertical spread. So watch what happens as I select vertical. It pairs up the individual strikes with a strike that's 2 strike increments away from it. So instead of going like 370 to 372.5, it goes 370 to 375. And down here I can find my 385, 390. So Don, you didn't know about that? Yeah, that's a nice little tool. And so now I can see the combination of the two, and I can eyeball with both of those options, even combining their bid-ask spreads, what's the total spread between the worst bid fill and the worst ask fills? The worst bid fills and the worst ask fills. Yeah, you can see 330 to 375. That's pretty close. 345 somewhere in the middle. We might not be able to get 345, but let's see how we can do. Actually, right now, maybe. But let's click on the ask price now, and that creates a vertical spread for us. And it looks like it might be closer to 355, maybe even 360. Let's dial this up. Say that we're willing to spend up to 360 to get into these contracts. If we're spending 360, that would leave $1.40 for profit potential. That also means we have $360 per vertical spread at risk. Now, in this webcast series, we've been risking up to $4,000. That would mean we might be able to do 11 of these contracts. Let's dial this up to 11. It almost sounds like a pop culture reference. Yeah, but this speaker goes to 11. I don't know if anybody gets that joke. Not that joke, but that reference. Anyway, let's confirm and send our order. Buying 11 of these 390, 385 put verticals. That would leave us with maximum loss just below our $4,000 threshold. Max profit of $1,540. Yes, when we do these sorts of trades, there's a larger risk than reward. It's because the reward is much more likely than incurring the loss. There's also a commission to be paid here. So that increases the total cost a little bit. And let's send that order off. Yeah, talking's hard, Carol. That's exactly right. Don says you always turn your music up to 11. All right, so where did we fill there? Let's go have a look at that. We have, and maybe we want to map this out as well. Let's see, our Microsoft position is going to be right down there. When we first place that trade, it goes down into our unallocated field. Let's right-click on that and move that to our long verticals and diagonals group. There it is now. So we can open that up, and it looks like $350 was the cost there. $18 minus $14.50 was $350. That's our trade price. All right, so let's go map this out on our chart. So our resistance is right here. And I'm just going to draw in a line there. Let's draw in another line starting right here today. And let's carry that right on out to expiration. I should have put that a little bit above the current resistance. That's okay. I'm going to right-click on this, edit the properties of that second trend line, and make it, that one's our red, pardon me, that's our short put option. It's right there. And then the long one, we bought that up here. And I'm going to put in a line there. Let's edit the properties of those, or of that one. So these are just to show us when we started the trade, how long it goes, and where the long and the short positions are. And so from here, we're really looking to get anywhere under that vertical spread is where we want to be. This is our max gain territory down here. Anywhere above that is our max loss. We don't want to be up there. So let's right-click on that box. Let's make it red. There we go. So there's our current position. Eric says, how do you change color on drawings? Did you see how I did that, Eric? You right-click on a drawing once you made it and edit its properties. And you can see there's a color palette right there. Just by clicking on color, you can choose from these defaults, or you can go to more and you get a bigger palette. All right. And you can also change the properties of other drawings by right-clicking on them. But somebody asked a question, when do we get out of this trade? That's a really good question, okay? This trade may work or it might not. So there are a couple of ways that the trader can plan for either one of those scenarios. And these can be automated if we prefer. So we know that we just bought this vertical spread for $3.50. That leaves $1.50 of reward potential. So if we bought at $3.50 and it goes to $5 of value, that's about as good as this trade can do. Well, for some traders, they might say, well, you know what? If I can get halfway to that, especially if it happens quickly, maybe I'll just take the profits right there. So here's what the trader might do. Let's go to our Microsoft position, right click on that, and let's create a closing order right now to sell that vertical spread. Obviously, we don't want to do it right now while it's worth basically what we paid for it. Instead, let's say we need a credit of at least, what's halfway between $3.50 and $5? $4.25. So let's put in $4.25, and let's say that we'd be happy with that if it happened relatively early in this trade. Now, this is a trade that has how many days remaining on it? Let me just minimize this order for just a moment. I'm going to click on this little down arrow. That just hides our order for a second. And this has 14 days. Let's say, you know what, if we can get half of the max gain out of this within the first 7 days, let's get back out. That would be this time next week. Right now it's Thursday. How about I'm going to put on a second requirement for this trade. Let's open that back up. I'm going to come over here and click on the little gear icon and say, I want to cancel this order next week. Here's the logic of this. We're automating this to get us out with 50% of our original maximum theoretical gain if we can get it quickly. If we can't get it in that first week, well, maybe we'll just hang around. Let's see if it takes a few more days, and maybe we can even push this closer to expiration. Could possibly get the full gain. But let me just save that. That's an order condition. Don't know if you knew you could do that, but basically when you add a condition, you're saying this is what I want to have happen to sell out of my vertical spreads for $4.25, but only under these conditions. And in this case, the condition is it has to happen before April 10th. Let's make this a good till canceled order so it doesn't just expire on us. Actually, yeah, that's good. Let's click confirm and send. Let's put in our order to sell our vertical spread for $4.25 if we can get it. There would be a commission if we met that, but that would be a $75 profit at a minimum on 11 contracts. That would be what, $825? Let's send that order off. There we go. So what about if the trade is going poorly? This one, obviously, if we put in an order to get out at halfway to our profit, we're leaving some profits on the table. That's sort of a given. I've also discussed previously how putting in a stop order on these kinds of trades has possibly an unintended consequence. And that is, when we put a stop on a vertical spread that we know on its way to expiration, the stock's probably going to be going around and doing something like this, right? Going up and coming down. But as of the moment we're initiating this trade, this is a high probability trade. The stock is where it needs to be. We just need to be below our vertical spread as we get toward that April 18th expiration. But most vertical spreads along the way, at least at one point, start to look like they were a bad idea. And if there's a stop order in there, it may end the trade with a loss. And so I took some extra time. I don't have the time to repeat this whole discussion again today, but one of the trade-offs of adding a stop order to minimize the downside risk of a vertical spread is that when we start off with a high probability scenario, adding that stop usually changes it into a low probability trade. In other words, it becomes a high probability that we trigger the stop somewhere on the way to expiration. Maybe it was just a one-time blip and the trade's done. So yeah, RP says a stop order is a double-edged sword. So for this example, I'm not going to be adding a stop. It's not that I'm saying that stops shouldn't be used under any circumstances. Some traders prefer them, some don't. For this one, I'm not going to add a stop. But I wanted to talk through that and also mention, yes, we could add a stop. I'm just not going to. All right. But guys, with that, we've actually planned and placed our example trade. We'll see how this goes. We know that we have $350 at risk per contract. We have $150 of reward potential per contract. But for that first 7 days, we're saying we'd even be satisfied with $75. So we'll see how this plays out. We've managed our other 7 positions. I got to say, right now we're treading water across the whole spectrum of those positions. Actually, because it's not just we're treading water. We just took some profits off the table. So this is actually better than is now reflected. Anyway, everybody, we're going to follow up on these trades in next week's webcast. I hope that you'll join me then. Also, want to give you an invitation to join me in each of my webcasts between now and next Thursday, because I have something new. I have a different series every day of the market week. So I'd love to see you in those other webcasts. But I have a couple of suggestions for you as we wrap things up here. Number one, make sure that you have subscribed to our channel. So if you're not a subscriber yet, pop down, click on the little subscribe button. It literally only takes a second. It doesn't cost anything, but our YouTube channel is where we house all of our previous webcasts. And so when you're subscribed, go find our channel, Trader Talks Schwab Coaching Webcasts on YouTube. And right here on our homepage, you can find our playlists of previous webcasts, and you can join our live streams right there. Now, also make sure that you are following Connie and me on X and all the rest of your favorite presenters. You can find Connie on X at Connie Hill CS. You can find me on X at Cameron May CS. Make sure that you're very precise with that handle. My handle here is at Cameron May CS for Charles Schwab. There are other accounts on social media that are very similar. Some of those are innocent, some of those are not so innocent. So just make sure that you always know who you're dealing with on social media. And if you have that account, you're dealing with that guy. Okay? But this is the best place to connect with us in between our live streams. And you can also get things like, hey, I just posted a video that I just made about what's happening on the S&P 500. I want to check that out. All right, everybody, go enjoy the rest of your day. Thank you to all the people that have already clicked the like button. It looks like 42 out of the 170 watching right now have already done that. Thank you very much. That sounds like applause to me, and it also gives my webcast a boost in the YouTube algorithm. Helps more people find these webcasts. So yeah, if you'd make a habit of just clicking the like button whenever you enjoy one of these webcasts, it helps your presenter. I will see you next week. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.